Hello everyone. In this video I'm going to walk through how to calculate the required rate of return on equity or the cost of equity for a firm using several different models. On this sheet I go through each of the models that I'm going to work through. The first one is the capital asset pricing model. The second one is the discounted cash flow model. And then the last one is the bond yield plus risk premium model. I'm going to be using Capital IQ's Excel add-in to do this, and what I'll be using is this document here just to show you the formulas that we're working through, and also this spreadsheet. On the spreadsheet, let me make this a little larger here. On this spreadsheet you'll see there's three tabs at the bottom, one for the capital asset pricing model, one for the discounted cash flow model, and the last one is for the bond yield plus risk premium. Okay, so going back to the document, the first one we're going to look at is the capital asset pricing model. So here are the different equations that we're going to work through. The first one is the risk premium for the individual stock. That's what the capital R means. It's risk premium, and so we take the returns for the individual stock and we subtract out the risk-free rate. The second one is the risk premium for the market, which is the returns for the market minus the risk-free rate. And then to get the market model, to estimate the market model, we regress the excess, or the risk premium for the individual stocks on the risk premium for the market to estimate our alpha and our beta. And so finally the expected return for the individual stock is equal to the risk-free rate plus the beta multiplied by the equity risk premium. Okay. So let's go ahead and do that. On our spreadsheet, the first thing we want to do is show our names up here just to make sure that we're looking at the right information. So I've got the identifiers that I'm using on the in column Q over here for the capital IQ. So I'm going up to my tab here for Capital IQ and opening the formula builder. And the first area up here is for the identifier. I'm going to use the cell rather than typing in the identifier. You can type in the identifiers up here by selecting this circle. However, I want to be able to drag this down and refer to each identifier in column Q. So my first one's going to be Q, this one here, Q2, and I'm looking for the general information and the company name. This is also going to give us the name of the market index that we're using and the risk-free rate that we're using. And then I just select Add Formula, press Apply. Now notice that I originally put my cursor in cell K2, and so that's where the formula will go. Now I can just drag this down and it's going to fill in the other ones as well. So the market index that we're using, or the market proxy we're using, is the Wilshire 5000 index fund. You can use other ones as well. You can use the S&P 500, for example. There's a variety of different market indices that would work here. The second one is the risk-free rate. I'm using the yield on the United States Treasury constant maturity 10-year yield for that. And then the firm that we're going to look at today is Pepsi. So you always, whenever you're finished with an area like this, you want to close this out, because if you try to then use it somewhere else, it's going to go back to the original cell. All right, so I want to find Pepsi's price and then the price for the index here for the last 60 months. And I'm ending with March 1st, 2021. So it's going to give me the price of Pepsi stock on that day. So I select cell B7, go to Formula Builder, and so again my identifier is going to be Pepsi over here, and I'm looking for the market data and then select equity market data and go down to, I want to use the dividend adjusted day close price. The reason I'm using that is so that we also get the impact of dividends in our pricing and in our returns. And then the as of date, I'm going to select that, and I'm going to go over here and select A7, the last date that I want to use here, and then just select add formula and apply. And so what it says is that on March 1st, 2021, the dividend adjusted price for Pepsi was $129.59. I'm going to make two adjustments to the formula up here. So the first adjustment is with Q4. Actually, I don't need to make that adjustment. I'm going to adjust that once I drag it over. But I do want to adjust the last item here, and that's the date, because I don't want, when I pull this over, I don't want this to go over to column B, but I do want, so I want it to stay in column A, but I want it to change as I drag it down. So I'm just going to put a $sign in front of A. There we go. So that's going to allow me to drag this over. And once I do that, it says invalid identifier, so I want to put this on identifier at Q2, the market index. And now I'm going to lock in Q4, and I just press F4 to do this. It puts a $sign in front of the column and the row. And then I'll do the same thing over here with Q2. Another way to do this is to name those cells. But for our purposes today, I'm not going to do that. And then I just drag these down all the way, and it'll update my prices for each time period there. Okay? And we can make that look nice too. All right. So the next step here is to calculate the returns. So I'm going to put in equals the natural log of the most recent price divided by the previous month's price. And now I can just drag this over to the market return and drag it all the way down. The reason I'm using the natural log of the gross return is because we're looking at multiple periods. If we were just looking at one period, then the holding period return or the net return is appropriate. But because we're looking over multiple time periods, we want to account for compounding, and using that the natural log of the gross return does that for us. For my risk-free rate, we're going to use once again the yield on the 10-year U.S. U.S. Treasury constant maturity. So I'm going to put my cursor in F7 and then go to Formula Builder. My identifier cell then will be the identifier for the risk-free rate in Q3. I'm going to go to Equity Market Data, and I'm going to go to last sale price here. The date, so last sales price, and then the cell as of date, select A7, so that's the last one we had. And so one thing to look for whenever you put your formula is that you should have in general, okay, there's going to be cases where we don't have the last item because it's not a date specific value, but your first item here is going to be your identifier. The second item is going to be the variable you're looking up, and then the third one is as of the date. Okay. So I've got all that information in there. I can add the formula, press apply. And it looks a little strange because Capital IQ reports this as a number. I have the format as a percentage. So what I want to do here is two things. So this is the monthly, what we're looking for is the monthly risk-free rate, the periodic risk-free rate here. So I want to divide this by 12, and then I also want to divide it by 100 because this is converted. This should say 1.45%. So I'm going to divide this by 1200, so 12 months out of the year, and then dividing it by 100 as well to give me the periodic rate for the month. All right. And then I'm going to drag, make sure I've got to make one other change. I need to lock in that identifier, and again I press F4. I'm just going to lock that in then and drag it down. And again, you can name those cells as well, like risk-free and things like that. So you can just put in the variable there too. So the risk premium for Pepsi is going to be the return for the month minus the risk-free rate. The risk premium for the equity is going to be the return for the market minus the risk-free rate. And don't drag this one over or you're going to get something really, really strange. All right, there we go. And now I can pull this down all the way. And then I'm going to go back to the document just to show you where we're at. Now you might notice that I have one more month out here for the price, and you have to do that because you're using the previous month's price to calculate the return. So you should have all of this filled in now. So I'm going to switch back over to the document just to show you where we're at. We've calculated the risk premium for the stock. We've calculated the risk premium for the market. Now we're going to estimate the market model. Okay. That's what I'm going to do right here. I'm going to highlight the light blue area. And this is going to give us some of the information that we need. We need the beta, we need the alpha. We're going to calculate the t-stat and the p-value. And we do this not because we're going to use it in our calculations, but just to see if this is statistically significant. Okay. So I've highlighted the blue area. I'm going to go up into my formula bar up here and type in equals LINEST, so it stands for line estimation or linear estimation. Open parentheses, my known y's. My dependent variable is going to be my Pepsi risk premium. And I highlight all that by just pressing Shift and Control and the down button. And then comma. I'm going to scroll back up now. Do the same. So these are my known x's or my independent variables. Control Shift and then the down arrow again. And then put in a comma. We want the intercept, so we're not going to put in false because then it automatically sets it to 0 and calculates the regression that way. We want to put that to true and then comma. We also want the additional regression statistics, so I'm going to put in true there as well. Close parentheses, but don't hit enter yet. Now you want to hold down Control Shift, and the reason why we're doing this is because we're filling up that entire blue area. So we want Excel to treat this as an array, not as a single cell. So we're going to hold down Control and Shift and then press enter. And you should get that in there. And this is what it will look like up here. You can see where when you press Control and Shift and then enter, it puts the brackets on the outside there. So what we see here is that the beta coefficient is 0.53. And the R-square for this regression is 0.30, so it explains about 30%. The regression explains about 30% of the variation in Pepsi's risk premium return over the 5-year period, which might seem low, but that's really kind of normal for a single company. To calculate the t-stat, we just want to take the coefficient and divide by the standard error. I'm going to pull that over so we can calculate this for both the beta and the alpha. So to calculate the p-value, what we're going to do is put in equals t dot dist dot 2t. And so what this tells us is the p-value for a two-tailed distribution. Then open parentheses. Our x is going to be the absolute value of our t statistics. So I'm going to put in equals, or just put in abs and close parentheses and then comma. And then my degrees of freedom. My degrees of freedom are 58 because I have 60 observations and I have 2 parameters. And so it's going to be 60 minus 2 to get our 58. And I want to lock this in because I'm going to drag it over to the right. So I'm going to press F4 here. And then I'm going to close that out. Okay. So definitely statistically significant. Very, very low p-value. And I'm going to pull this over to the right. And this is definitely not statistically significant at 0.92. For this one, you can do a variety of things. You can estimate the average over time. You can use the current risk-free rate. In this example, I'm going to use the average for the time period that we're looking at. I'm also going to use the equity risk premium for the time that we're looking at. A lot of equity risk premiums are forward-looking. For the demonstration I'm giving you today, I'm going to use the one for the time period that we're looking at, but certainly you're going to find out that it's pretty large over this period, and the reason for that is that for one thing, the risk-free rate was abnormally low, and then for the other issue is that the last 5 years at this point, there's been a lot of turbulence in the stock market, and so investors have been requiring a higher risk premium. So my risk-free rate, I'm going to use the risk-free rate, the average risk-free rate for the period that we're looking at. For this, I'm going to put in equals. And so now I want to take the average risk-free rate, periodic risk-free rate, and I want to annualize that. So what I'm going to do is put in equals 1 plus the average. I'm going to highlight the risk-free rate here. Close parentheses. And then another parentheses and raise that to the 12th power to annualize it, and then subtract 1. And that gives me a nice round number, 2% for the risk-free rate. Again, that's pretty low historically. And then I'm going to use the equity risk premium for the last 5 years. I would not recommend doing this for 1 year because you can certainly get into a situation where you have a negative equity risk premium for a single year or even 1 or 2 years. And that's something you'll need to think about as you calculate this on your own. But I'm going to use, again, I'm going to do the same thing I just did with the risk-free rate. So I'm going to put in equals, then 1 plus the average equity risk premium right here. I'm going to highlight all those. Oops, not all the way over there. There we go. Close that parentheses, a second close parentheses, then raise it to the 12th power and minus 1. And let me scroll back up here so you can see that. So the same formula I put in for the risk-free rate, but now putting in the returns for the equity risk premium instead. And I get 14.23, and that's pretty darn high for a equity risk premium. But again, part of that comes from the fact that the risk-free rate was so low during the time period. So my estimated cost of equity is going to be equal to the risk-free rate plus the equity risk premium multiplied by the beta coefficient. And I'll switch back over to the Word document where you can see where this formula came from. And so for Pepsi, the estimated cost of equity using the capital asset pricing model is 9.59%. So I'm going to switch back over to the document to show you where that came from. So we estimated the market model, and we multiplied the beta for Pepsi by the equity risk premium and added that to the risk-free rate to get the expected return for the stock. All right. So the next one we're going to look at is a discounted cash flow model, and we take the dividend yield plus a growth rate. The dividend yield's easy to get. It is available publicly. The growth rate is something we're going to estimate, and make sure that when you calculate this, you always add after you calculate the growth rate, always add the dividend yield in. That's where I see a lot of people make mistakes. They'll calculate the growth rate and say that's the required rate of return, when in fact it should also include the dividend yield. All right, so the growth estimates we're going to look at are the retention growth rate. And the retention growth rate is equal to the return on equity for the firm multiplied by, this is the retention rate, so it's 1 minus the dividend payout ratio. We're going to use analyst estimates for long-term estimated GPS growth, EPS, not GPS, EPS growth. And we're also going to use historic dividend growth for the firm. So I'm going to switch back over now to the worksheet. All right, so I'm going to go to my second tab here for the discounted cash flow. I'm going to make this a little bit bigger so it's easier to see. I always like to just double check to make sure the name, I'm looking at the right one. So if you select B2, or excuse me, B1, this goes back and refers to the same identifier for the firm. So again, I'm going to go to Capital IQ, Formula Builder. My identifier is going to be B1. And then I'm going to go down here to Company Info and General and the company name, and add that formula in. And so we have the right one. I've got the as of date up here. I've got 12/31/20 because some of the things we're looking at are year-end values. And so we want to make sure that we're looking at the right time period. You can certainly change this, and if you want to look at a different time period. So the first thing we're going to look at is the dividend yield. And I want to use the current dividend yield for the stock. So I'm going to go up here to Formula Builder. Oh, sorry, I need to close this out. Now I'm going to go back to Formula Builder. Okay. My identifier cell stays the same. It's going to be B1. And I'm looking for the dividend yield. So I'm going to go up to my data item keyword here and just type in dividend yield. All right. And I want to select dividend yield here. And it's also under the equity market data. And because I want the current one, I'm not going to put a date up here. And so I've got my identifier, I've got IQ dividend yield. I'm going to just press apply. And then I need to divide this by 100. Okay. Now when you do this, you're going to get probably a different one because this updates. So the last time I worked through this, it was 2.76, but because the price has changed for Pepsi during that time period, since then, it changed the dividend yield, and I just messed that up. Let me go back. So what I want to do down here is I want to divide this by 100, because again, Capital IQ reports this as a number rather than as a percentage, so I want to change that to a percentage. So the dividend yield for Pepsi is currently 3.06%. So the next two, I'm going to use the fiscal year end. So I've got a date here. If I put today's date in, you'll see I'm going to show you what it looks like if I don't adjust it for a fiscal year end. And then I'll adjust it. So if you were to put in today's date, it would look for the fiscal year end 2021, which hasn't occurred yet for Pepsi. So you would get an error there. So what I'm going to do is go to Formula Builder. Again, my identifier is Pepsi, PEP, the ticker there. And then I'm going to go down here to the, financials and financial ratios and return on equity. You can also use return on common equity here. For Pepsi, it doesn't matter. And for most firms, it's not going to be a big difference. And then I want to, I'm going to show you what happens if I don't adjust this for the fiscal year end. So I'm going to go to cell for the period and just put in as of 12/31/20. Okay, and so it says invalid time period. So I need to fix that. So what I'm going to do here is highlight this. And where it says F1, I'm going to change that because I wanted to say the fiscal year end for that year, for that date. So here I'm going to put in the command concatenate. So what this does is it allows me to create a term, a word in that formula. And I want to tell it the fiscal year 2020. So I'm going to put concatenate. The first text I'm going to put in quotation marks and the term FY and then a comma. And then I'm going to put in the command year and then highlight the date here. So what it's going to do is going to put in FY, which stands for fiscal year, and then the year 2020. And then I'm going to put in one more close parentheses and actually another close parentheses. And I need to divide this because, again, Capital IQ reports this as a whole number. I've got this formatted for a percentage. So I'm going to divide that by 100. And so what it's saying is that this formula is putting in this area, the date area, FY 2020. And so it's looking it up based on that. All right, so to get the payout ratio, we're going to do the same thing. We're going to go to Formula Builder. And my cell is B1 for the identifier. The keyword here is payout ratio. So, and that comes from the income statement you see there. And so I'm going to click on payout ratio and then go to cell and as of 12/31/20, and then I'm going to add my formula there and apply. And it's going to give me an invalid time period again. So I'm going to do the same thing to fix the time period. I'm going to go out here to the last argument in the formula there, or in the function, and put in concatenate, open parentheses, quotation marks, FY, close quotation marks, comma, and then year. So again, what it's telling the computer to do in that function is to put FY 2020 for fiscal year 2020. And then I put two more close parentheses there to close it out. And then now what I want to do again is I want to divide that by 100 because their payout ratio really shouldn't be more than 1, certainly not 77. So they pay out about 77% of their earnings as dividends here, which is not unexpected for a company like Pepsi. It's a mature company. You know, if you think of that BCG matrix, it's a cash cow. The next item is the analyst estimates for EPS growth. So for this one, I'm going to open up Formula Builder. I'm going to go to, again, put in for my identifier B1. And then I'm going to look up estimates. So you see up here estimates right there. And I want to go to CIQ estimates, which stands for Capital IQ. And then consensus. And so I'm looking for, scrolling down, EPS median right there. Okay. And I'm not going to put a date in here because this is, again, something that just updates periodically. And so I want the most recent updated item. So I'm going to add the formula and press apply. And then again, I need to divide that by 100. Oops, there we go. And so your function here should look like this. And the analyst estimates for EPS growth, and so this is a 5-year estimate, is per year is 6%. So they expect the earnings per share to grow by 6% on average per year for the next 5 years. And then the last item we need to look up here is the historic dividends per share growth. So again, I'm going to go to Formula Builder. I'm going to go to put in for my cell, my identifier B1 for Pepsi. and I'm going to look up my growth ratios under financials. And I'm going to scroll down because I want 5 years. So you can see it's got 1 year, 1 year, 1 year, 1 year, 2 year, 3 year. And then I get down here to my 5 years. That's what I want. And now what I'm looking for is the CAGR. That is the compound annual growth rate. Now I'm looking for my dividends. There we go. Dividend per share, 5-year compounded annual growth rate. So I'm going to put in add formula and apply. And again, it's not 780%. I need to divide that by 100. To give me 7.81%. All right, so those are all my numbers there for my growth rates. So now what I need to do is I'm going to calculate my first one here, which is going to be the retention growth rate plus the dividend yield. So the retention growth rate is equal to the ROE multiplied by 1 minus the payout ratio. So that's my growth rate. And I'm going to add to that my dividend yield. Now, you know, as I'm going to demonstrate later on, we can't use every estimate for every firm. And in this case, this ROE is extremely high. Okay, and that's for a reason. So we wouldn't expect that high of a return on equity for a mature company in a mature industry like Pepsi. What's happened over the last several years is that Pepsi has been taking out debt and using that to repurchase stocks. Okay, so if you think about how return on equity is calculated, it's net income divided by common equity. Well, Pepsi has been significantly reducing the value of their equity on the books over the last few years by repurchasing stock. So because of this, this is probably not an accurate growth rate for Pepsi. So for the analyst estimates, expected earnings per share growth rate is 6.05%. Well, again, we want to add that to the dividend yield. We get 9.11% for our estimate for the cost of equity. And then finally, historic growth. We're going to take that historic dividends per share growth, and we're going to add to it the dividend yield. And we 10.87%. So far, it's kind of nice. This is a nice one to look at because our capital asset pricing model says that our estimated cost of equity is 9.59%. The discounted cash flow model, we've got 3 of these, but 2 of them are fairly close together, 9.11 and 10.87%. So we're kind of seeing maybe that there is a convergence around a number, which is kind of nice. You don't always get that. I'm going to show you an example when we're done with this where that is not the case. All right. So we've calculated the capital asset pricing model. We've calculated the estimates for the discounted cash flow model. And just as a little review here, I'm going to go out to the document. So for this one, the discounted cash flow model, we have the dividend yield plus growth rate. We estimated the retention growth rate. We got the analyst estimates for long-term estimated earnings per share growth, and then the historic dividend growth. Okay. This one was really large, and I explained why that was, and these other 2 here were fairly close to each other. So the last one we're going to look at is the bond yield plus risk premium. The idea behind this is that the returns for a firm's stock should be higher than the yield on its bonds, and that should always be the case. So if you're getting a calculation where the yield on the firm's long-term bonds is higher than the expected return on equity, there's something wrong there because stockholders face more risk than bondholders for a firm. So their required rate of return should be higher. Okay, so we can get the yield on the firm's long-term bonds. I'm going to show you that, how to get that. And then we're going to calculate the firm's equity risk premium. So we have three different approaches the beta multiplied by the equity risk premium, the average of the historic return for the firm minus the risk-free rate, and then what's called the Fed model, which is the expected earnings per share divided by the price today, minus the yield on the 10-year U.S. Treasury. And one thing we're going to use for that is we can get the forward price to earnings ratio from Capital IQ. That's just a variable that we can pull in. And we take the inverse of that ratio to get the EPS, the forward EPS divided by the price today. All right. So we're going to go back to the spreadsheet. And we're going to select our last item there. And I've got here need to look up. So this is something at least I have not been able to determine how to pull this out of Capital IQ using the add-in. So I'm going to go out to Capital IQ. I'm going to show you where to look this up at. And I would say it's important to look it up because I'll show you a problem with just importing in a number there. So I'm going out to Capital IQ, and I'll pull it up on the screen here once I log in. All right. So I'm out here on the front page for Capital IQ. I want to look up Pepsi. So I'm just going to put the ticker symbol in up there, and it's going to give me this as an option. That's what I want. And now I want to scroll down to fixed income. So if I look up summary over here on the left-hand side, this is usually what I use to find that long-term rate. So this is the summary page for fixed income, and there's some good information here. It tells us the ratings for its bonds, some of its bonds. So in general, Pepsi has an A+ rating from Standard & Poor's on their bonds. That's not universal. Sometimes different bonds will have different ratings. And then the benchmark securities is usually where I look. So I want one that is about 10 years out for my long-term bond. The problem here is that what we have here is 10 years away, okay? But the yield, and it says yield to W means worst, but this is the yield to maturity. It's 0.337. That's a problem because that's lower, much lower than the risk-free rate is for the same maturity. So actually what I want to do, and I'm going to show you what the problem here is, I'm going to go out to security summary over here on the left-hand side. And then I want to go out to 2031 for my different bond options. So the last one here on the second page matures in February 25th of 2031. The type is a senior unsecured corporate debenture, which is the normal, corporate bond, and it has a yield of 2.094%. So that's the one I'm going to use. I'm going to go out to one more page here to show you the one that they have on the summary page. So the one we see on the summary page is this top one up here. And I think the reason why it's given is it's got the date closest to, I'm recording this on March 11th, 2021. So this one is really the date closest to 10 years out. The problem is that this is not a normal bond. This is a foreign currency debenture. And so you can see here, these two are both foreign currencies, and the yield is much, much lower because these aren't normal bonds, okay? These are used oftentimes to hedge against currency risk. So I'm going to go back to the previous page, and I'm going to use this bond here. And it's 2.094 for the yield. So that's the number I'm going to use for my long term. And you can see here it's pretty close to 3 years as well. So I'm going to use 2.094 as my long yield on the long-term bonds. And I'm going to make that a percentage. And so this is bond yield plus the risk premium. That's the bond yield we're using. And by the way, that is a low bond yield for a 10-year bond. And that's just because interest rates right now are extraordinarily low. The next item is the beta multiplied by the ERP. We don't bring this in from Capital IQ. We actually calculated this before on the first page. I'm going to go to CAPM. Again, this is the beta multiplied by the equity risk premium. So, oh, sorry, let me go back out there and put an equal sign, equals, and then go back to the first tab there. The beta multiplied by the equity risk premium, and that gives me 7.59%. The next item is the historic firm risk premium, and then I'm going to go press equals, and then go back out here to the CAPM. And so what this is going to be is the risk premium for Pepsi. So what I'm going to put in my formula up here is, actually I'm going to take away that, and then I'm just going to put in open parentheses 1 plus. So I'm going to take this monthly return risk premium and I'm going to annualize it. 1 plus the average. Then highlight the Pepsi risk premium here. Raise it to the 12th power and subtract 1. And I'll press enter once I do that. And I'll show you the formula when we get back to the page there. Oh, and I apologize. I need to, oops. I left out a parentheses. There we go. It should look like that instead. So I want to raise, and just to show you what I was doing, I want to raise the 1 plus the average return to the 12th power, not just the average return. And 6.68%. And then finally the Fed model. So for the Fed model, the first thing we're going to do is look up that forward PE. And so I'm going to go to Formula Builder. And I'm going to put in, for my identifier, I've got over here, and I forgot to put the names in. I'll finish this up by putting the names in up here. But my identifier here, and it's linked to the first page where I put it in. So if you want to be able to use this for multiple different firms, don't update these on each page. Just put the value in on that first page. So now I want to get the forward price to earnings ratio. So I'm going to go to trading multiples, and I want forward multiples. So I'm going to go to CIQ forward multiples, and I want the forward PE. Okay. And again, what that is that's the price today divided by the expected earnings per share for the next annual period. And because I want the current one, I'm not going to put a value in here for the date. I'm just going to put in add formula and apply. And the forward PE is 22.08. Which is pretty normal. I mean, that is, you know, if you look at the historic PE ratio for the S&P 500, that's about in line with average over time. So that's a good thing. Okay. And we're going to use the current risk-free rate here. So again, I'm going to go to Formula Builder. And my cell is going to be the identifier here for the risk-free rate. And then I'm going to go to market data, equity market data, and last sale price. And then just add, and again, we don't put a date in here because we want the last one. And when you open this up, I'll show you this too, you can hit refresh and it'll refresh all the values for whatever time you're looking up. And then I'm going to divide that by 100 because the risk-free rate is not 153%, it's 1.53. Oops, and I did the wrong thing there. Let's undo that. I want to select this cell and divide it by 100. And it's 1.53%. So the estimated cost of equity for the first one, we take the yield, bond yield plus the risk premium. I take the bond yield, 2.09%. plus the beta times the equity risk premium. So it's 9.69%. The second item here, I'm going to take the yield on the long-term bonds plus the historic firm risk premium to get 8.78%. And then the Fed model, for that, I'm going to go back to the document. So for this, we're going to take the inverse of the price to earnings ratio and subtract out the yield on the 10-year US Treasury. So I'm going to put in equals 1 divided by the PE ratio, so that's the inverse, minus the risk-free rate. And what we want to do is then add in the yield on the long-term bond. So it's the bond yield, and our risk premium is from the Fed model. And that gives us a value of 5.09%. And in part that's because let me just show you the inverse of the forward PE here is 0.04529. So that one is fairly low. All right, so last item, just to make this complete, I'm going to add the names in here. My cell is the identifier, and I go to the company info, go to general, company name, add formula, all right, and so then I'm just going to grab this and pull it down, and it's going to show me Pepsi again. So that's it for calculating all the estimates. I just want to review the estimates, and then I'm going to show you what we do here to change this to a different company. So we've got, for capital asset pricing model, our estimate was 9.59%. For the discounted cash flow model, we have 3 estimates. One's at 14.49%, and I explained why that one's kind of high. It's because this ROE is high because they've been recapitalizing the firm, but the other 2 are 9.11% and 10.87%. The last item here, the bond yield plus the risk premium, 9.69%, 8.78%, and then 5.09. And this one's kind of an outlier on being on the low side as well. So if I were analyzing this, you know, it appears that several of these kind of converge on about the same number, and that's not necessarily a good reason to use it, but you know, we can see why these are outliers. The forward PE here, like I said, isn't out of line terribly with the average over time, but part of the problem here is that the yield on the bonds are low, and because the rates for government bonds have been kept very low, which results in the yields on the firm's bonds being low. So this one I think is probably a little too low, while these are more in line, and that's because the risk premiums have also adjusted for that low, I think that's probably the best way to say it, for that low risk-free rate. Okay. So, you know, again, we seem to have a convergence around that 9 to 10% for the cost of equity for the firm. What I usually look for after you've calculated this up is to explain why you would use the one that you're using. And like I said, 9 to 10% here seems like a good estimate. And then just mentally, what would an investor require to invest in Pepsi? Pepsi is a safe company historically. They have a good dividend yield, so they're paying out cash. So you're not going to probably require, the average investor wouldn't require a very high return. So 10% kind of fits that idea as well, 9 to 10% there. All right, so now what I want to show you is if we change the identifier, what happens? So I'm going to change this to a very different company. We're going to look at Tesla instead. So I'm just going to go out here and put TSLA. That's the ticker symbol for Tesla. And you can see everything changes out here. The beta is much higher, 1.84. Statistically significant. Risk-free rate doesn't change. The equity risk premium doesn't change because that comes from the market identifiers. The estimated cost of equity is 28%, much, much higher required rate of return in this case. But maybe that is a justifiable value too, because Tesla is a much riskier company, and they've kind of achieved that kind of a return there. We're going to see that later on. Go to the discounted cash flow model. Tesla does not pay a dividend. The ROE has been very low. They don't have good earnings at this point yet. They're working on it. Analyst estimates, still not great. Actually, if you go back and look, it's less than what it is for Pepsi. But again, Tesla might be considered to still be in that introduction, maybe beginning growth phase. So they're not going to be generating a lot of cash flows at this point. That's why they have no dividends. The historic DPS growth is not a good one here because they, again, have no dividends. And the analyst estimates for growth, those could be incorrect, or they could just be, they're still in that process of getting ramped up for future growth. So these are probably not good estimates for Tesla. The bond yield plus the risk premium, we need to go out here and get this number again. So I'm going to go out to Capital IQ again, and I'm going to put in for Tesla. Waiting here. All right. And then I'm going to go to fixed income summary. And I like to start here because oftentimes there is a representative bond out here. So we can see the yield to worst is, or yield to maturity is 4.718, which makes sense. Tesla's a riskier company. Their bond rating is a double B. So I'm going to go ahead and use this one to 4.718%. And what we get here is three wildly different numbers. The forward PE is so high because their earnings are low. Okay, their earnings are low, and so the forward PE is so high. So we get a very low Fed model value here. The historic firm risk premium, this is high because their historic firm risk premium is 75%. Their stock has grown dramatically in value in the last 5 years, and that's what's showing up there. The third item is very close to what we saw before. So this seems really high to me, but it also makes sense because and this is the value we get here is 30.85%. It makes sense because Tesla is a risky company. And so their investors in that company are going to require a high return. So you can see here with Tesla, we get very different outcomes and a much wider expectation for returns there, or different estimates for returns. So if I use the beta value, and I'm not always a big fan of this, but in this case, right now, it's a pretty decent, I think a pretty decent estimate. It's 28% here. The bond yield plus the risk premium is 30.85. So we're kind of getting, again, two estimates that are kind of close, around that 30%, 29 to 30% range. Let's just do one more, just for the heck of it. All right, so I'm going to put in here Walmart and see what we get. All right, so Walmart's beta makes sense again. It's 0.39, and that makes sense because Walmart is a non-cyclical company. They do well in good times, they do well in bad times. So we would expect a low beta there. The estimated cost of equity for the firm is 7.55%. My discounted cash flow values, retention growth rate, they have a higher ROE, and actually for the same reason that Pepsi does. They've been recapitalizing, they've been taking out debt, and they've been using it to pay, and they've also been using retained earnings to pay off their to buy up their stock. And we see this with a lot of major companies right now. You've heard of stock repurchases maybe in the media. That's what's happening here. So the analyst estimates for growth of 5.39%. The historic dividend growth has been low lately, and again, possibly because of their recapitalization. That might have played into that. So we get retention growth rate of 12.86%, but probably a little too high in that case. Analyst estimates of 7.05%, and then the historic growth based on this low dividend growth rate here was 3.63%. Finally, I need to look this one up because their yield on their bonds is not going to be anything like that. So again, I'm going to go out to Capital IQ. I'm going to put in Walmart. Their ticker is WMT. And so we see, I want to look this up because you see here, this one is going up 5 years. Again, we don't know anything about the bond, but their yield is actually negative on that one. And then it's 1.19% for the December 30th bond. And again, that's a little low because it's lower than the risk-free rate. So I'm going to go out here to security summary over on the left-hand side. And again, I'm trying to find one that's close to 10 years out there. So we don't have a whole lot to choose from. We've got these two bonds. But again, that really low yield, the 1.19%, this is not an actual regular bond for the firm. The one above it matures February 15th of 2030, so we're about a year shy from what we're usually looking for. And it's 1.996%. And you can do a little estimation here. So I could push this up, bump it up to around 2% or a little above that. I'm just going to go ahead and use this value here, though. So it's 1.996%. And so we get a situation where the beta multiplied by the equity risk premium for the firm plus the yield is 7.54%. The historic firm risk premium is 16.85, and this is because the historic firm risk premium, the average return over the last 5 years has been 14.86%. And then the Fed model, and again, the reason why this one's so low is because the PE ratio here is probably a little higher than what would be the norm for a company like Walmart. Okay. So again, we're seeing a little bit of convergence like we saw with the Tesla one, 7.54 here, 7.05 here, and then finally 7.55 here. So I would probably again place this one in that 7.5%. And again, what I'm also doing is mentally thinking through as an investor, what would I require? What would the average investor require for a company like Walmart? It's a safe company. It has a decent dividend. And so our required rate of return would be a little bit lower than the average. So the average return on the S&P 500 over long periods of time is between 10 and 11%. So 7.5% makes sense to me here. And that's one way to think about it. Anyway, that's it for this video. Please let me know if you have any questions.